So what we're going to do is we're going to talk about what we can do right now to avoid having a big tax hit in 2015. Earlier this week, I actually was quoted in a press release that resulted from an article came out that talked about the federal government collecting over $3 trillion in 2014 and how it's such a great thing. The overall increase of 20% in tax revenues that was accounted for by a 6% higher individual tax rate and a corporate tax increase of 17% higher. However, our spending was flat at 3.5 trillion. So those of you guys can add knows that we're at a deficit of about a $500 billion. Where does that money come from? That comes from the private sector, which means that really what they're doing is they're shifting the money. They're saying, yes, we're collecting greater revenues, and basically that, hey, the economy is increasing, but congratulations, we're collecting lots more tax revenues. In other words, we're shifting income or revenues out of it over to the government. And obviously that's going to be if we get to the point when we have great enough increases to where the percentage of tax in the economy is big enough that it actually equals the $3.5 trillion spending, then we'd have a balanced budget. For those of you who are not aware, we were down to, I think in 2008, about $2.1 trillion in tax revenues. So yes, there's higher revenues. For those of you guys who can do math too, is if we had 20% more in tax revenues, only 6% came from individual taxes, 17% higher corporate taxes. I guess the way I should put it is we had a 6% increase in individual taxes. Corporate taxes increased 17%, but we had an overall increase in 20%. Then where did the rest of it come? It came from other taxes by government, estate taxes, etc. So I always look at these things and say, yes, there's an article out, it's awesome, but let's be real. At the same token, numbers just don't add up. So I figured I'd throw this out at you. Hey, we're government accountants. These numbers aren't supposed to add up. That's about right. Reality-wise, the government just ended up increasing its revenues off of us. The numbers don't quite add up. When you're looking at big increases in business, if you have a 17% tax hike, that doesn't necessarily mean the revenue went up. It just means that if you increase tax on these companies, which we are in one of the worst tax environments in the planet, we are not even in the top 30 as far as business tax regimes in the world. Of course, you're going to have greater revenues. So that brings us the question of what do we do about it? So I like to do this whenever I teach a live event. I like to talk about Disney World. And Disney World is interesting because whenever you fly into Orlando and you land at the airport, you're going to see lots of signs that are going to take you to Mickey Mouse and his friends. You actually see Mickey there, Minnie, Goofy. I don't know what the chipmunks are, and Donald Duck. All along the way, you're going to get to stop off and drop off some of your hard-earned cash at these things called toll roads. So when you get off at the airport and you follow the signs, you're going to be paying a tax along the way. What a lot of folks don't realize is that parallel to those roads, or just about parallel, are other roads that do not have tolls on them. The only difference is that the locals know that there are these roads, and if you are just flying in, you may be unaware that they are even there, that you even have that option. And so what ends up happening is someone goes out there, they fly into town, they don't know any better, and so they're going to drive on the roads that the signs will take them to, and that's going to be the toll road. For taxes, that is no different. The rules are fairly complex. So let's just throw this up there. The Internal Revenue Code is absurdly complex, or as we lawyers say, a gold mine. It's very complex, and it will oftentimes keep you from doing any planning, when in all reality, if you just know of the existence of a few of those roads, you can get to where you're going a lot cheaper. So you don't have to know every road. You just need to know the road that's going to get you to where you're going. In order to get where you're going, you need to have a plan, because if you don't know where you're going, then any road will get you there. I'm sure you guys have heard that before. The tax code, by the way, is over 20,000 pages with over 1 million pages of ancillary regulations, interpretation, and case law. So if you ever meet somebody that believes that they know the tax code, it's just not going to happen. So what we're going to do is we're going to be very succinct, and we're going to decide what are we really talking about doing tonight. We're going to talk about what we can do right now, and we're sitting in October. We have a few months left to really do something before the end of the year. And what can we do to minimize our tax bite? And these are the topics that we're going to talk about. So if we're looking at this as a map, we're looking at minimizing the overall taxes we pay. So we're not necessarily going to talk about avoiding taxes. We're going to talk about a lot of things of minimizing and shifting and doing things to take an overall look at between tax years and taxpayers, which will be clear before we're done, what we can do so that for every dollar we make, we're paying the least amount required by law on those revenues, so that we're keeping as much in our pocket as humanly possible. So we're going to be talking about shifting income. We're going to be talking about stacking expenses, something you guys may have heard before. We're going to talk about avoiding unnecessary gains, and we're going to talk about deductions that you can take before the end of the year. So let's jump in. Let's talk about shifting income. Different ways to shift income. We can shift from one year to the next. We can shift between taxpayers as well. We can also defer or accelerate. So let's go one by one. What does shifting 1 year to the next mean? And is it actually relevant to you? So let's say that you are an employee, and every year your employer gives you a bonus. This year in particular, you've had a very good year on doing your side businesses. Maybe you're a real estate investor, maybe you're a stock market trader, and you've had more gains this year than you'd normally had, and you're in a higher tax bracket. So one thing you could do without doing any sort of crazy structuring is say to your employer, could you please pay me any bonuses in January that you would ordinarily pay me for in December? And that's something that you just go to your employer and say, hey, what if you need the money? Well, take a draw on it. Say, I just, need a draw on it. It depends on your relationship with your employer, obviously. If it's a smaller company, these things are fairly easy to do. If it's a larger company, obviously it's more complex. If you work for your own company, then it becomes pretty easy. You're having a conversation typically with yourself, and you're trying to determine whether or not shifting it would make sense. So what does shifting income really mean? It means that if I know my tax situation is going to change from 1 year to the next, again, if I've had more gains this year, or perhaps I was unemployed for part of the year, or perhaps I suffered some losses in some activities that this year I'm in a lower tax bracket. So let's use real numbers. Let's say that I'm married filing jointly. We're in 2014, and I'm at about $100,000. It means I'm in the 28% tax bracket. And ordinarily, I make somewhere in the $300,000 mark where I'm at 35%. Then I may say, hey, I'd rather have some of this income now than later. Perhaps I was laid off. Perhaps, maybe I just took a sabbatical. Then I might want to have income shifted into this year. And so the same situation is you go to your employer and say, could you pay me a January payroll in December? You may be surprised that some employers are willing to do it because they're doing the same thing. They may say, yeah, we want to have some expense that we know we're going to incur anyway, and we'll just pay that to you ahead of time. And you say, well, what's their risk? Well, their risk is maybe you have some PTO or some time off saved up or something, so they don't have a lot of risk. They're just going to go ahead and pay you on December 31st, have you run payroll, deposit into your account, and take that deduction. It shifts it into your tax year where you have a lower tax. You also may have some appreciating assets, and you say, hey, maybe I want to take that income now. Or let's say that you have a company that has a different fiscal year end, and for those of you who know fiscal year ends, that's really, we're talking about a C corporation. and maybe we're gonna play a few uh, uh, kind of fix a puzzle or put the puzzle together where we say, hey, we have an off year end. Maybe we can defer some of those taxes from one year to the next. Maybe we have a corporation that's going to have a better tax bracket than us, so maybe we shift some income from one year from my tax bracket over to it, and or maybe we're looking to shift, maybe it's at a higher tax bracket and it wants to shift some of the income to me. Then maybe it's going to pay me out before my fiscal year end, which may be 12/31. So to put that in English, if you have a C corporation that has a March year end, for example, there's a lot of you guys out there that do. So March, June, September, you may look at your personal tax situation and say, is there a way for me to get income out of my tax bracket into a corporation and remove it from my tax bracket this year, but where the corporation does not pay tax on it immediately in the following year. This only works if there's a staggered fiscal year end. If it's an S corporation, both of your year ends are 12/31. It's not going to matter. So if I move $25,000 from my personal realm to the corporation, yes, that corporation still has $25,000 of income, but its tax year end may be March. It now has 3 more months to get rid of it. What I know for certain is that I am not paying tax on that money come April 15th. I am shifting that income. I am deferring it. That's all I'm doing. Vice versa, if you have a corporation and it's sitting there and it has a year end that where maybe it has a March year end and it's looking at some sizable gains, it can also look at you and say, what is your income this year and what is your income next year? And so if you have a W-2 job that's not shifting and the only thing that's going to be different is how much money it pays you, then the question is, does it pay you part of it in this year and part of it in next year? Would it be better off just dumping it all to you in this year or all of it in next year? So if you have the same income, obviously it makes sense to possibly separate that out over 2 years. So if we have a C corporation, again, maybe it has an extra, let me just use a number like $50,000 that's going to be taxed at a higher corporate rate. So maybe it's made $100-some thousand. It can pay 25,000 of it in 12/14, and then shift and pay another $25,000 in 12/15. I hope that is making sense to you. The next thing is maybe we defer or accelerate income. And so we say, hey, instead of receiving a contract, maybe I have a contract on a sale of a business or a piece of property, and I have payments that are due in 12/14. In fact, I just ran across this yesterday. Actually had a client who had sold a business for upwards of 7 figures, and they had payments that were coming due at the end of the year, and they were in the 39.6% tax bracket. This was all hitting them. And I said, do you really want to have that in 12/14? And they said, absolutely not. I don't want to have it hitting me in 12/14. I'd rather have it next year. I said, let's go to the other party and see if they'll defer some of that payment into 12/15. It makes sense. It shifts it into another tax year. Now, does that mean that they're not going to be in the same 39.6% tax bracket? It may not. Maybe they're able to keep their income lower. There are some income reduction techniques, and there's some investments they could do. Maybe they qualify as a real estate professional. Maybe they have working interests in gas and oil, or something that could lower some of their taxes. But even if they didn't, what it's doing is at least it's deferring out the tax for as long as humanly possible. In that case, it may be another year. Accelerating income. So again, I'm in a situation where I've had a down year, I've had lots of losses, and maybe you have active losses this year. And so I can think of a situation where somebody has a $100,000 active loss. Maybe they want to take some income into this year, and so you go to that same situation. You say, hey, I know you have payments due in January or February or March of next year. How about we accelerate it into the 4th quarter of this year instead of the 1st quarter next year, and see if they're willing to do that. And all we're doing is we're saying, what's the best situation for me over a set period of time? And that's really all you're doing, is you're laying it out and you're looking at 12/14 and 12/15. You're saying, hey, when is it best to have that income hit? And making your choice from there. I like this one as well. Good news, I spoke to our accounting department. 2 plus 2 does equal 5. No, that's not quite how it works, although that's how some of us would wish it would. Let's talk about stacking expenses. So for a lot of us, if you called up the IRS and you said, hey, can I write off my medical expenses? They're going to say yes. That is absolutely true, but misleading. There is a 10% adjusted gross income floor that they're going to have to that you're going to have to exceed before you can write off a dollar. So if you make $100,000, it means the first $10,000 of your medical expenses are not deductible. So if, for example, in 2014, you've had $10,000 of expenses under that scenario, where you've had medical expenses that have added up, and you know you're going to continue to have more medical expenses, you've exceeded the adjusted gross income floor. Every dollar you're able to pay at this point is deductible to you, assuming that you're not phasing out because you have too high an income. You may want to shift future medical expenses into this year. How do you do that? You could pay them now. You could go to your provider. Let's say that you're receiving treatment. You could pay for 6 months of treatment ahead of time. You don't have to come out of pocket for it either. You could put it on a credit card. As long as a cash basis, taxpayer, we pay it, we get to write it off. So here you are, you're sitting in 12/14, you've exceeded your limit, and you go ahead and you prepay something that you're going to pay out anyway, then you're going to be far better off. The thing to be very careful of are the phase outs. And the phase outs occur when you're using itemized deductions and you make too much money. For married filing jointly, it's around, I'd say, $300,000. For single individuals, it's going to be closer to $250,000. But when you go above these amounts, you're phasing out of your itemized deductions, which includes medical expenses, property tax, real estate tax, sales tax, mortgage interest deductions, and even charitable deductions. So all of these things, you need to do a little bit of planning. And I hope that I'm not, confusing you, but on the same token, I hope that you're realizing that these are not something that's just super simple. You just look at it and, hey, in 5 minutes I know. It's something you really need an advisor to sit down and talk to you. There's also a second tax system that we have to consider, and that is called the alternative minimum tax. And that's where we calculate tax without state and local deductions, miscellaneous itemized deductions, property taxes, etc. And you may be in an AMT situation where you don't want to pay any of these expenses. So what happens if you can defer some of these expenses into next year? So let's say you got injured in December. The longer you can hold off paying medical expenses, the better off, because if we can push them into 12/15, we may be in excess of our 10% adjusted gross income floor. Other things that folks do is they prepay those itemized expenses. Maybe their property taxes, they prepay some of their property taxes for 2015, their real estate tax. Maybe they prepay some mortgage interest in 2014 to capture it. Maybe they make a charitable deduction or donation at the end of the year, knowing that they need that deduction because they're in a high tax bracket, and they pay something that they would have paid in 2015 in 2014. And again, so long as you pay it, it doesn't matter whether it came out of your bank account. It could come off of a credit card. So if you're somebody who's had a very great 2014, you're not phased out, but you're at the same token, you're not going to make that much money in 2015, maybe it's time to prepay some of these things. Maybe it's time to make a charitable donation. You say, hey, you know what, ordinarily I tithe maybe $5,000 a year. I'm just going to go ahead and pay 2 years in December. And I'm going to take that deduction now because it means more to me now. Does that make sense? I hope so. Other one, when you're stacking expenses, medical expenses, obviously when we're talking about C corporations, you can, assuming you don't have a bunch of employees, but if you're doing a medical reimbursement plan, that's 100% deductible anyway. So if you have a corporation, for example, that um, has income and taxable income, and you know that you're going to have personal medical expenses, if you prepay them, your corporation can now reimburse you. So you may prepay something that's coming up in the next few months. Hey, I know that I'm going to be undergoing this procedure, so I pay it now. That corporation can now immediately turn around and pay you and lower its income as well. So again, these are all things, these are pieces to a puzzle that we put together and try to put and make as beneficial to you as humanly possible. Something I did not hit on, and I'm just going to jump back a couple of slides, is shifting income. We talked about shifting income to a corporation. We talked about shifting income between 2 years. What we didn't talk about is shifting income to other people like our children, and that is really shifting years and taxable entities. And so if we have kids and we have a business, we may put them on payroll. Or if you're a sole proprietor, you don't have to put them on payroll, you just pay them, which I don't particularly like taxing people as sole proprietors. It doesn't give us a lot of options, but some of you guys are doing it anyway. You're shifting it down to their tax bracket. A lot of you guys are saying, well, what about the kiddie tax? That's on passive income. If my child is making active income, they do have deductions that are available to them. They have the standard deduction. It depends. Some of these things depend on whether or not you're claiming them as a dependent. If they are a minor, then probably they're going to be a dependent, but they're still going to have a portion of that income that's at the 0% tax bracket. And so they have active income. You could pay them, for example, let's say about $9,000 tax-free. For those of you guys that have kids that are going to college, it's far better to have them pay for their college at their tax bracket than your tax bracket. So when we talk about shifting income, these are things we're going to look at. We may be looking at your tax bracket, a corporation's tax bracket, even your children's tax bracket. But the kids have to provide meaningful labor. In other words, it can't just be I hand my child some money. They actually have to work for your business, which you should have them doing if they're that old. If they're 16, 17, 18, get them involved in your business. Have them doing something that they can receive payment for. Even if it's $2,000 a year, that's $2,000 that may come out of your 39.6% tax bracket. If you have state income tax, we have folks that are at basically 40, 44, 45, 46%. You save practically 50% on that money and get it down to a child who you're going to be paying for things anyway. It just makes sense. So I wanted to make sure I touched on that one. And obviously, if you have parents or anybody else that you can get involved in your business, these things, it just adds more taxpayers to add to this puzzle so that we have more pieces that we can play with and we can see what's going to be the best situation for everybody. So moving on. We have more accountant humor. All right, so the optimist looks at the glass as half full, the pessimist says it's half empty, and the accountant says, hey, it's twice as large as necessary, right? Well, hopefully we're looking at our bank account and saying, hey, the bank account inside that corporation is twice as large as necessary. Let's dump some of that into our individual, and maybe our individual, we're going to have a better tax rate, or vice versa. Maybe we have too much money in our individual tax bracket, and we say, hey, we have twice as much as necessary there. We dump it over. So that moves us on to the next one, which is how to avoid unnecessary gains and losses. And this is one of those areas where it's a bit of a rabbit hole. So I don't want to confuse anybody. I don't want to go into things that are into the minutia. So I'm going to talk about very general concepts here, and then I'll give you some specifics for application. So the golden rule on capital assets, and that is if you buy real estate, if you buy stocks and bonds, if you buy or sell options, the golden rule is it's not taxable till it's sold. We want to calculate. What happens if I sell it? Do I have unused short-term losses? Do I have long-term gains, short-term gains? Do I have long-term losses, short-term losses, things like that? And I want to see what are my gains that are sitting in my account. A lot of you guys know or kind of aware that quite often at the end of the year, we'll have a little bit of a run up in the stock market, and then there might be a sell off in January. Some folks believe it's because everybody's in a good mood around Christmas. Some people believe it's because people are selling stocks to pay their credit card bills for all the buying they do during the holiday season. Whatever the case, there's a perception that that's going on. And so some people may say, oh man, I have these gains. I need to sell my stock. Before you do it, know what the tax ramifications are. If you have a stock that you've held for 11 months and you're going to dump it because it's run up, you really need to evaluate whether it's better off to use one of the items number 3, which is either a put, or if you have a stock that you want to make sure you don't lose value, and whether you buy a call on it, or buy a put on it so you can put it to somebody else. If you have some losses in your account and you have a strong portfolio, maybe you want to sell some calls that expire before the end of the year so that they're taxable in this year to offset some of those losses. Again, if you have short-term capital losses and you have ordinary or active W-2 income, you're limited on how much of that loss you can take. You're limited to $3,000. So maybe there's some left over, and you say, hey, how do I make sure that I don't leave that lying on the table? Well, here's some things you can do, but you have to do it ahead of time. And the golden rule applies to puts and calls too, which is they are taxable when they expire or they're sold and they're extinguished. So it really is kind of a big deal. And you sit down and you get your pencil out and you determine what is the tax ramification to a sale, what is the tax ramification, or what is my risk if I don't sell. And so for those of you who aren't aware, a put means I can force someone to buy my shares at a certain price. It's hedging my bet. Now, it does toll my holding period. So if I have an 11-month stock and I buy a put, it's going to toll my holding period, and I'm not going to hit my long-term gain rate. But if I'm just trying to get through the end of the year and I'm trying to get myself to where maybe that stock's normalized, that's fine. And more importantly, I didn't sell the stock and incur a taxable gain in 2014. So if nothing else, I've deferred my tax and I moved it from 1 year to the next. I hope that's a concept that people are understanding. It just means that we have a few tools in our toolbox that we can use to hopefully prevent something from being a taxable event, to prevent something from causing us to pay more tax than we necessarily have to. And so again, if I'm going to repeat this, it's basically number 1, the golden rule is capital assets are not taxable until sold, and that includes options. You calculate before you sell. You determine what are my gains. If you're concerned about the gain, you want to make sure that you don't lose it, then you can buy hedging instruments like puts and calls to make sure that you don't lose money. Or if you have a strong portfolio and you have losses in your individual name or in the entity name, and you want to have something to offset those losses, you want to capture some gain, but you don't want to sell your portfolio and have the taxable event, you may sell some calls that are short-term calls. And in either case, you're going to get the money from the call, and either it's going to expire and you're going to be taxed on that, or you're going to get called out. Regardless of the situation, what we want to do is use up that loss in this particular tax year, because we're saying, hey, that's going to be beneficial for us when we do our calculation. Whenever I talk about calculations, some people say, that seems really complicated. Well, it's like driving across a bridge or walking across a bridge. I don't want to be walking across the bridge to determine whether or not it's going to hold my weight. I want to do some calculation before I ever step foot on the bridge. So if I'm walking out over a big span of maybe it's a big cliff, I don't want to find out that the bridge won't hold me when I'm halfway across. I want to do my calculations. It's almost some engineering. And so I want to figure out whether or not it's going to hold me ahead of time. And taxes are no different. I want to know what my tax liability is before the end of the year. I want to know exactly what I'm looking at because I don't want to find out after the fact. I don't want to find out in March or April, or in some cases in September or October. And I've been guilty of this, where I'll have a loose idea of the numbers, but I didn't actually sit down and try to get my return done or do a real calculation. It hamstrings you guys because we have to do our planning ahead of time. Knowing what our taxes are going to be for 2014 in November allows us to do things before the end of the year to try to minimize that tax or defer that tax. And if you just wrote a big check in October for your individual taxes that were done last year, you know what I'm talking about. Let's do the calculation now. So even if you know you're going to have a tax bill, you're able to prepare for it. All right. The IRS. I'll take the job if you can pay me under the table. Yeah, it's not something you do to the IRS. I don't think that they would laugh, but I kind of laugh. Anyway, all right, deductions. How are deductions calculated? We're cash basis taxpayers. So we know that when we pay something, again, even if it's with a credit card, that it's deductible. All of these planning techniques that we do then become, hey, if I make the payment, then I know at least I can write it off. The exceptions are when we're talking about retirement plans and things like that. If you're doing a higher end retirement plan, a defined benefit plan, for example, and let me just give you guys 2 minutes on the difference between these types of retirement plans. A lot of folks are familiar with IRAs. In an IRA, we're defining the contribution. Hey, I can put in $5,000, $6,000, whatever it is, on an annual basis. I get to define that. And, the only exception is, what if I make too much money? If you have a 401k, hey, I could put 17.5 in it, going up to 18,000 in 2015. If I am a pension plan, I can put in $52,000 or a SEP. A defined benefit does the opposite. It looks at your income and says, how much money do you have to have in your account when you retire in order to continue to pay you that money? And these are much more sizable amounts. A defined benefit plan is simply something that you're probably putting upwards of $100,000 a year tax deductible into, but it is something that has to be in place for the business before its year end. And so if you have a 12/31 year end, then this plan has to be in place ahead of time. And that's different than making the contribution. Contribution, typically you have up until it files a tax return. For example, like a SEP, the business tax return is a big date. For pensions, business tax returns, big date. We want to make sure that it's making those contributions ahead of time, but the plan itself may have to be in place prior to the end of the tax year. We don't want to play games. We don't want to do the backdating and all that stuff that some of these advisors do. You want to do this the right way. And so if there are sizable income tax obligations, then giving us a couple of months to determine whether or not a defined benefit plan might save you a lot of money. And I've actually had clients where over a 2-year period, they were able to dump upwards of $500,000 into a plan, tax deductible. We can't do that calculation unless you come to us prior to the year end. And this is not something that you come to us on December 15th. These are calculations that are typically done by actuaries where it's going to take a little bit of time. This is something you'd really want to start doing now. And so if you've had a big year, if you run your own business, if you are a doctor, a dentist, a lawyer, a consultant making over a couple $100,000 a year, then a defined benefit plan may be something you want to look at. We want to determine what we can put into a retirement plan. Then even if we haven't funded it, we want to know that that's available to us. Same thing if you're funding a 401k or a traditional pension plan or an IRA. You want to determine, what am I eligible to contribute before the end of the year, so you can determine what your tax liability is, so that come next year, come 2015, when you have to make the contributions, you're able to determine how much do I need to come up with, because you may be sitting at the end of the year and you don't have the cash. But if I know that by March or April, I need to fund this thing, it gives me time. Or maybe I have until September of next year or October. It gives me time to accumulate either the credit Because remember, when we're a cash basis taxpayer, as long as we get the money in the plan, we get to write it off. Maybe I borrow the money to fund my plan. That's not necessarily a bad thing. Maybe I'm taking a line of credit against receivables to fund it. Whatever the case, I'm able to determine what I can do to affect my tax bill. And if I know that if I put $10,000 in a plan, it's going to save me $4,000, yeah, I'll pay a little interest, especially if I'm borrowing it out of my own plan, which I won't get into all that, but there are ways. And so again, I tell you, we're going to be talking about kind of the broad strokes. There are ways to access capital, even in your own retirement plans, to do some tax planning. And so that kind of gets us. Laws that are changing. Well, there's a few. As you guys have known, Congress has been really active over the last few years, and we have a few tax provisions that are looking to possibly expire at the end of 2014. A big one that you guys are going to, if you didn't know about this, and again, hopefully it's nobody on this call, but if somebody sold their house at a foreclosure or had debt forgiveness on their house, then in 2013, the debt forgiveness expired on your home. They have yet to extend that. They keep talking about it. But things that did get extended into 2014 are things like solar car credits. There's some tuition credits, but they're set to expire in 2014, at the end of 2014, although Congress keeps talking about extending them. There aren't any of the huge ones. One big change for businesses was the Section 179 deduction that, we had 100% bonus depreciation a few years ago. Now we're down to $25,000. We had it up at upwards of 500,000. Now we're down to 25,000. So if you buy equipment for your business, you know what I'm talking about. A lot of folks took advantage of those law changes. It's something to continue to watch, because whenever we want to spur the economy, whenever Congress wants to spur the economy, one of the ways they do it is by trying to increase spending. And one of the ways to incentivize a business to increase spending is to get them to make capital expenditures that then they can write off. Going all the way back to the very beginning of the seminar when I talked about the press release, and that Uncle Sam has collected more revenue. It's an all-time high of $3 trillion. One of the things I look at was a few years back, companies were investing in equipment in a big way, and they were able to write off the equipment to the tune of, millions of dollars of equipment that they put in service. The problem is as a cash basis, you get to write it off immediately, but then you have to pay for it. And so some of these companies have been paying for it, but they're getting taxed on that profit. They're getting taxed as profit on that revenue. So they got a big tax deduction a few years back, and now they're paying taxes on it now, which just means they deferred it, and there's absolutely nothing wrong with it. But let's not pretend like the economy is back to where it was. And I think that the federal government is being disingenuous if it believes it has come back to that point. Now, there are pockets in the country where maybe you're saying, no, we're awesome, it's back to where it is. But I'm just saying overall, from what I can see, it has not. Last thing, if there's any questions, and then I'm going to go into two more slides, but I want to know if there's any questions right now that anybody needs to ask. I'm looking at the site. I can see it if you go onto our website and you're watching this down below. If you post a question down there, I can answer. How do you move income from personal to corporate? Is this 1099 income? And then how do you prepay medical with the doctor? Great questions. Okay, let's go through those in bits and pieces. So quite often we'll have income, personal income. And when I say personal, it may be in the form of a stock account. It may be in the form of rents. It may be something that's being generated either through a side business, an MLM or whatnot. If you have that in an entity, so for example, if I have my brokerage account in a limited liability company that's being managed by a corporation, then I have a couple of different ways the money can get moved into the corporation. The first off is a guaranteed payment to partner. And I say to that corporation, I agree to pay you $500 a month, $1,000 a month, whatever it is, to handle the management, the accounting, the bookkeeping, the oversight of the account. I'm agreeing to pay it as a guaranteed payment to the corporation, and then I pay it. What if I don't pay it? What if I can't afford to pay it?
the way I always look at this, I like to use donuts as an example. Let's say your employer says, um, go out and bring donuts in for the office, and you spend $100 on donuts, really good donuts, pink box donuts, whatever they are, voodoo donuts if you're in Portland, and you bring them on in, and they say, I'll pay you when I can. Can they do that? Yeah. Now, what if they wait a year? Does it matter? No. If they pay you the $100, they can write it off. They pay you the $100, it's a reimbursement. It's not necessarily taxable to you. Same token, I could have an agreement with a third party to pay them for services. I say, hey, you do this, and then you don't have the money to pay them. Does it mean you have to pay them right then? No, they have the choice. They can say, all right, pay me when you can, pay me when you have the money. So it's no different between you and a corporation. You may owe that corporation some money. Well, maybe now's the time to pay it. Maybe now's the time not to pay it if I don't need the deduction. So when I do pay it, then it becomes something that is going to become a deduction to me. So same thing as if I want to pay it a management fee. It's done a really good job. Maybe it's a property manager for my real estate. Maybe it's managing intellectual portfolio, a bunch of websites. Maybe it's managing, again, entities that have everything from brokerage accounts, maybe whatever. You can fill in the blank. I can pay it. I don't have to pay it. I'm on both sides of that transaction. As long as it's reasonable, I am okay. In other words, if you could pay a third party to perform that service, then you can pay a related entity to perform that service. And so whether or not I pay it, maybe something as I say, hey, it behooves me to pay it so that I can take the tax deduction right now. Is this 1099 income? Well, the beautiful part about paying a C Corp is anything over $600 typically is 1099 income, but when you pay a corporation, you don't have to give it a 1099. That's only for a C Corp, although some accountants will also do that for an S Corp. If you pay somebody else, yes. How do you prepay medical? With the doctor? That's a good question. It depends. It depends on your relationship with the medical provider. Usually it's either with the doctor, or if you have a chiropractor, you may go to them and say, hey, I want to prepay for some services. I want a discount. Or if you're in therapy, or for some of you guys are working with life coaches, I guess it would have to be prescribed if it's going to be a life coach. I'm thinking of like therapists, psychologists, psychiatrists. Maybe you're in some sort of counseling or whatnot. You can prepay if there's sessions that you're definitely going to have, or for yourself, for a dependent. If you're in a rehabilitation from a car accident, for example, or a fall or a trip, or maybe you just played soccer and you banged up your knee and you know you're going to be going to 10 sessions in the next few months, could you prepay them? Yes. Can I grab that when I pay it? Absolutely. And that's typically how you do it. Next question is, do phase outs apply to passive income? It's adjusted gross income. So everything that's part of your income becomes part of your phase out. So it's adjusted gross income. So whatever your adjusted gross income flows up to, absolutely. Let's jump on. Any other questions out there? Let's just going to refresh. There was a few. I think I answered most of them. Let's see. What do you think the right amount of taxes we should be paying on a percentage basis? If the government is taking so much money, don't you think it's too high now, Bob? Interesting question. I know that most practitioners are looking and saying, if you can keep your taxes somewhere south of 25%, you're doing pretty good. As far as the government and its progressive tax system, it is too high. I can tell you, having dealt for 2 decades with corporations, that foreigners don't like doing business with U.S. corporations. They prefer to have it in a jurisdiction like Malta's 5%. I mean, but you have to justify why it's ending there. So here we have the U.S., which is this beacon of light for capitalism, and everybody wants to do business here. But if you go to Tax Foundation, you look at the jurisdictions of where the best tax regimes, we're not even in the top 10, guys. We're like 30 something. It's not great. It's pretty far down the list. So what we're doing is we're forcing our corporations to go to other jurisdictions. And if you do not believe this is going to have an impact on us, it absolutely does. And so you look at what the Googles of the world are doing, what they're, and it's kind of like, I don't blame them. I understand why they're doing it. It's because if they keep it here, they're going to get slammed. But on the same token, we as a country should be probably trying to incentivize them not to do that. I'd rather get 20% of something than a whole lot of nothing. Um, let me see if there's any more questions. Would it make sense to buy a car included as a tax expense? Well, that's an interesting question. It depends on how it's used. So the question is, cars. I'm going to spend 2 minutes on this because it's really interesting and a lot of accountants screw this up. So if you are provided with an employer vehicle and you use it for commuting or personal use, that is taxable income to you. Believe it or not, they actually have a schedule and you look at the value of the car and it'll determine the lease value of that vehicle, how much you pay tax on. So if you use that car, for example, 80% personal and 20% for business, then 80% of that lease value is included in your income. Not necessarily a good situation, and something that a lot of folks don't account for, especially when 179, the equipment deduction, people were going out and buying SUVs and writing them off. They're still getting taxed on those things. Could you, though, go out and buy a piece of equipment included as a tax expense? Absolutely. If you buy a car that qualifies and it's 100% for business, absolutely, as long as it's purchased before the tax year end. And businesses do this prior to their fiscal year ends all the time. The government's notorious because they have a September year end and they're buying. And I used to have a company that was in the same building with us when I worked when Anderson Law Group was in Kent, Washington. And those guys, they were dumping their budgets because they knew if they didn't spend it, they wouldn't get it the following year. So they were dumping their budgets that last month. And we're talking about orders of 2,000 flat screen TVs. They would just burn through it. Hey, I have to buy equipment. I have to buy something. And so when you're coming up to year end, you have to decide, are there any expenditures that I'm going to make in the next 12 months that I could make now? Maybe I want to buy equipment. Maybe maybe it's my business. Maybe it's an S Corp or whatnot. Maybe I want to spend money, even if I don't pay for it. So the great example is, let's say I know I'm going to buy a laptop and I'm going to buy one for myself and two of my other employees or the board of directors. And I know that a good laptop is $2,500. So I could spend $7,000 now on a credit card and lower my tax bill $7,000, not my bill, but my taxable income. And if I'm in the 39.6% tax bracket plus state tax, I may be getting a huge benefit by doing that. And so, yes, if you are looking at expenses and whether you should make expenditures before the end of the year, then you absolutely then it could make a huge difference. Other question: if you take money from your LLC to pay yourself, is the $600 free limit same as corporation you just mentioned? Okay, so this is getting into 1099s and when you have to report. 1099 is just an informational filing. It's anybody that provides services, $600 a year or more. You're supposed to 1099 them, with the exception of C Corps. But if it's your LLC, it's not really paying you $600 for services. It's just giving you your money. Or if it's a disregarded LLC, for example, or partnership, then it's filing its 1065. You don't have to do a 1099. It's already being reported. The profit's being reported down to you regardless. So you don't have to do a 1099. I hope that makes sense. All right, last thing. All right, I always kind of do the what ifs, and I like horrible pictures of smoking babies. But what if you had unlimited CPA, EA, accountant, question and answer, monthly meetings where we could have topics like this, but you could ask lots of questions, an online portal where you can go in and you could submit questions, you can look at videos, you can look at FAQs. There's lots of past meetings that you can peruse. Plus, you get a 2-year tax review where they look at your taxes and tell you whether or not you overpaid. And by the way, just this week, we had another taxpayer where we saved him over $21,000. And there's a 10-step tax course from a former IRS trial attorney, one of the senior trial attorneys, Scott Estel, that walks you through how to take deductions for everything specific to trading, to real estate, to if you are running a traditional business. It goes over just about everything and the requirements for taking it. Plus, we'll give you personal audit protection on the reviewed return. Yes, we have that service. It's called our tax team, etaxteam.com. If you are a client, what we're trying to do is we're trying to blend it into the service. So if you are a tax client, rather than sit there and have you pay when you do a tax return. What we'd like to do is get you onto a flat rate system where you know exactly what you're paying on an annual basis, and you get access to the online system. You get your returns done. And if you want to get a quote and figure out how much it would be, or if you want to get lined up with the accounting department so that they can do some year-end planning for you, you go to our website, and on the very front page, you're going to see that little Learn More button. You click on it. It says click here. You come to us, and we'll arrange it so you can have a complimentary consultation, and they can tell you kind of some pricing and give you an idea of what it would cost and what they can save you and what they could do for you. Again, take advantage of it, guys. There's absolutely nothing to lose and everything to gain. If you do decide to use the tax department, or if you're a current client but you're not on flat rate pricing, talk to them about getting you on flat rate pricing. And it doesn't matter whether it takes us 20 hours or 200 hours, it's going to be the same price. We etch it in stone. It's just as long as it takes, but that way you have certainty, you know how much it costs. We have certainty. We know how many clients we have that we're going to have to do returns for, so we can plan accordingly. For those of you guys who know our business, we do, literally close to 5,000 returns a year. We are very good at business returns, but it is something where a swing of 200 or 300 clients can really be painful if they wait until the last second. So we like to have some certainty in our life so we can plan accordingly, so we can better serve our clients too. So we're going to incentivize you guys by giving you a lot of value added by putting you onto some flat rate pricing. So click on that Learn More to request a consult, and we can get somebody to talk to you. And again, even if they look at it and they determine, hey, I think that I could save you some money, or hey, I think that your accountant's doing a great job, at least you're better off for it. And make sure that a little bit of knowledge goes in there saying, hey, at least I have somebody who's doing it right. So that peace of mind can be done for free. That's it for me. I don't think I have anything else. If you ever want to get a hold of me, my email is tmathis@andersonadvisors.com, or just submit a request via that free consult tab and say, hey, I want to talk to Toby, or hey, I need to talk to Toby. Everybody here at Anderson Law Group and Business Advisors is our first initial last name at andersonadvisors.com. So if you're looking for Clint Coons, it's ccoons@andersonadvisors.com. If you're looking for Toby Mathis, it's tmathis@andersonadvisors.com. I don't think there's any more questions. I'm going to refresh it one more time. And that's about it. Oh, there's one more question, Tom. What direct business expense can I deduct? Anything that's a business expense and I prepay it on a cash basis counter. It means everything from phone to prepaying, even garbage, to phone services, to internet, to even your lawyer. If you prepay it, it's your cash basis taxpayer. It's when you pay it. So as long as it's done within 12 months, you're fine. So so you can absolutely go in there and prepay a bunch of expenses to minimize your existing taxes. And I suggest that you do that if you've had a great year. Not just the accountants and the attorneys, but any expense that you can justify paying in the first quarter as opposed to the fourth quarter. The fourth quarter as opposed to the first quarter. Pay it ahead of time, and takes the benefit, and vice versa. If you had a bad year and you can push those things off and hold off paying them until the first quarter next year, where you may have higher taxable income and you're going to be in a higher tax bracket, then it's beneficial to you as well. Click on the Learn More button, get a free consult, and then we can start doing the math and we can do the calculation to figure out whether any of this makes sense. If it does, great. We'll tell you what it's going to cost to do it. If it doesn't, then we part friends, and at least you have peace of mind knowing that you're doing everything you can. That is it for me. This will be posted as a recorded video, so you can pop on here just minutes after I'm done. If you want to send any friends, or if you joined us late, I could see that there was probably almost a couple hundred of you guys that were joining the broadcast. If you came late, you can go in and watch the beginning. And until I hear from you, I just want to say thanks for joining us. It's a big thing. I know to talk about taxes, it's sometimes confusing, but it's one of those few areas that's absolutely worth every minute that you spend in it, because it's going to put more money in your pocket. This is Toby Mathis from Anderson Law Group and Business Advisors. Good night.